We start today's market talk. Markets love hope. Being wrong is better than being left out. Indian stock indices have scaled new highs, running on the hope that companies will report another quarter of robust profitability. Overall, India Inc. is expected to report sales growth in mid single digits, while bottom line growth is expected to be higher. Auto OEMs, less commercial vehicles, consumer electricals, government driven capex, industrials, railways, defense and power, travel and tourism, real estate, etc., are expected to perform well. Market outlook, as I see it, US CPI came at high of 3.5% year on year for March, while China's retail inflation came in at a meager 0.1% year on year for March, while European Central Bank Chief Christian Lagarde hinted at a possible rate cut in June. So US CPI came higher than 3.2% for February. US bond yields went up immediately. Market expectations of Fed rate cut were pushed back from June to September. And that is also doubtful based on the inflation print and other issues. In China, retail inflation came at 0.1%, raising fears of deflation and cries for more stimulus. CPI in Eurozone came at 2.4%, prompting ECB chief to hint at a possible rate cut in June. In Japan, they are heaving a sigh of relief that inflation is on an upswing after years of negative interest rates. What is the reason? Reason is difference in growth. US economy grew at 3.4% in Q4, while Eurozone GDP growth was 0.1% only. This is the reason why there is a difference in outlook on inflation and monetary policy in all countries all over the world.
And difference in monetary policy action in all countries. Retail inflation fell in March 2024 to 4.85 in India. The good point is that India is outlier on growth, so GDP growth will be at least 7% plus for next 1 or 2 years, and retail inflation is falling. So the question is, when will India see rate cuts? In my opinion, it will depend on Fed action and monsoon performance. So all the monsoons action is generally in by around August, September. So expect a rate cut possibly in September, October this year. Uh, the other issue is Bloomberg commodity index has moved up sharply and is now at its highest level this year. Now, this is because the global March PMI shows expansion consistent with solid growth. And if case there are growth and there is growth all over the world, commodity index always moves up sharply. Uh, the another reason is US and UK have imposed new restrictions on trading Russian aluminium, copper, and nickel with rules which will prohibit delivery of new supplies to London Metal Exchange. And this is one of the reasons which is driving up the commodity prices along with uh, improvement in the economy in China, etc. Gold prices are scaling new highs. Usually, gold is subdued before the US presidential elections because dollar is boosted and equity markets are always pulled higher. Now, this is an outlier now because people are surprised, and the biggest buyers today are central banks, and I think from China, because gold is a defensive store of value. So, right now, I don't think retail is buying it, it is a big money that is banks buying it, while silver is finding industrial use in 5G handsets, solar panels, and electric vehicles. So, this is the reason for this spike in prices of gold and silver. Now, the other interesting issue is China's industry subsidies and overcapacity is causing large volumes of exports at depressed prices and an over concentration of supply chains. This is why Janet Yellen went to China and they had a discussion on this. China's problem is that it has built capacities in sectors like new energy, technology, manufacturing, etc., to a vast extent. They have They are also building factories in other countries such as Vietnam and Africa. Direct and indirect government support is currently leading to production capacity that significantly exceeds China's domestic demand as well as what the world market can bear. So sectors like photovoltaics, auto batteries, China has 80% of global supply chain. China makes 60% of electric vehicles worldwide. Their value chains are also highly cost effective because they are well networked. They are investing in steel overseas across ASEAN, Central Asia, and Africa. This will lead to global demand inelasticity, fall in prices, decline in capacity utilization, and a risk of systemic risk to global economy because the prices will fall. When this system will come up against determined economic nationalism in countries like US, Japan, South Korea, India, etc., there would be big problems globally and there would be some geopolitical issues. Problem of overcapacity will be seen in steel as Chinese steel demand is expected to see a downturn while production is going up. You can already see that they are pumping in a lot of chemicals all over the world, which has led to decrease in uh, chemical the complete chemical industry prices. Now, due to promise of AI, the magnificent seven stocks have done well. Now, again, here is very interesting because IMF says without ambitious steps to enhance productivity, global growth is set to fall far below its historical average. It says reforms that enhance productivity and fully leverage AI are key to revive growth in medium term. It says AI can add up to 0.8% to global growth, and the promise of AI has caused the magnificent seven stocks to do well in the US, and which is actually driving the US markets. What are these seven magnificent seven stocks? Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla. Now, interestingly, Kia and Hyundai have entered into a partnership with Exide Energy. This partnership is aimed at localization of EV battery manufacturing. Uh, Energy for localization of EV battery manufacturing, they have entered into this partnership with Exide. Short term impact on Exide performance is limited, but over long term, there may be positive results. I'll just show you the Exide chart. Exide was a normal market performer, and then last week it has gone up to around 400 odd levels. Suddenly there was a big bump up. It from around 320 it has gone to 400. So uh, this is FY25 expected EPS is around 14. This is now already 28 times. While global battery companies like LG Chemical, Samsung, SK Innovation, CATL of China, they all trade at around 10 to 12 times earnings. So this has now become expensive. So profit booking can be done in this. Now, the other key issue is ordering activity has been revived in thermal power and transmission sectors. So you must have heard that government has told the gas power plants to run at full capacity for next 2-3 months. Similar thing has happened with coal power plants, uh, which are importing coal. So thermal power plants equipment ordering has gathered pace in FY24. 8,000 megawatt, that is 8 gigawatt of orders has been given. Transmission segment has got orders worth around 40,000 crore. This is good for companies like BHEL and Power Grid. Utilization levels of coal power plants are at highest. Similarly, renewables require higher investment in transmission sectors. Hence, we are seeing upstick in all the stocks related to transmission also. Imported coal-based power plants are running at full capacity, uh, and approximately 80 gigawatt of thermal power is likely to be added by next 5 to 6 years, and we are the only country which is actually moving fast on this issue. uh, Rest of people are actually reducing their thermal power requirements. Now, Godrej Properties is an outlier in pre-sales of homes in recent quarters. You would have seen that the real estate sector has been doing well. Godrej Properties received recorded pre-sales of 9,500 crore in this quarter. Projects like Godrej Zenith in NCR, Godrej Reserve in MMR are doing well. But the only point is this is the Godrej Properties chart. So if you see it came down to its 100 EMA at around 2200 odd levels in March, and then after this it has risen up last with higher volumes. It went up to nearly 2800 levels now. So this year I think they're likely to do an EPS of around 24 25. So at this they are more than 100 times their earnings with all their debt and other issues. So it's a risky stock right now, so be careful with this. We'll cover certain technicals. I talked about the US inflation, and because of that, the US bond yields went up. They went to nearly 4.6, and which promptly led to the dollar index also going up. Dollar index went to 106. It has broken that declining trend line, so it is headed higher. But as I told you before the elections, always the dollar index strengthens. The Brent crude prices are expected to now go up with all this Middle East issues. So though it has broken above the declining trend line and reached that 90, but it can easily, if there is a supply disruption and all that, it can easily head to 100 odd, because there is a lot of speculation which takes place in this market. Gold, for some reason, is just going up and up, and it has reached around $2,400 to an ounce. So, despite cooling inflation, anticipated rate cuts by Fed, etc., gold prices are surging due to strong demand from China and absence of any substantial retail investor interest. Now, all the people who are getting bullish on the gold manufacturing or the uh, like stocks like Titan, etc., Senco Gold, Kalyani, and all should be careful, because the demand will fall very drastically if the gold prices are high. So the US inflation is still above Fed's target of 2%, and Jamie Dimon said that inflation would be higher forever instead of higher for longer. And I think impact is seen. US Nasdaq, it corrected, but it has made an all-time high and it has corrected after that. The reason is the US spending is healthy. Anyone who wants a job has a job, and companies are easily able to raise capital. So there is no need to actually cut rates at present. Now, this is India's 10-year yield. It is in a declining trajectory, but it is now going above the 20 and 50 EMAs. So it is also going up along with the US yield. So this is should be a concern, but it's not out of control. India VIX had declined to around 10.5 odd levels this week, and it recovered a bit because you could make out that there was a lot of complacency now building, and everybody was writing puts, as if the markets will keep going up. So it corrected a bit. This is Nifty. This is a weekly chart. What I was talking about, last two swing lows, this was one swing low, and this was the second swing low. So if you see on the weekly charts, this is the 21,700 odd level, and this one is 21,200 odd level. So these are the two last swing lows. So need to watch these two levels. Generally, the market retraces to these levels, but if you see, we are in an uptrend, and we are constantly making higher highs and higher lows. So this week actually we went to 22,800 nearly, and then came back from there. So uh, and Sensex made 75,000. So there is no cause of concern till the time this trend is broken. Now this is Nifty. So this is what I was referring to. Watch this 20 EMA till it is above the 20 EMA. Nifty, this is a daily chart. It's in a bull market, so probably I think the Monday opening would be somewhere closer to the 20 EMA, or in this zone up to 22 300. and after that we'll have to see if there is a follow-up buying or something like that. Otherwise, if you see here, last time it took support at this 21710 levels. So from there, that is the 50 EMA. It bounced back from there. So next support would be 50 EMA. So till the time it is 22,000, there is not a problem. It bounced back. This is the hourly chart. So if you see here, for a very short term, the hourly candles close below the 50 EMA. So which indicates uh, a bearish trend now, because it has to trade above this 50 EMA for a bullish trend, the hourly candle. But it made a high and then it has come down. This is the Nifty option chain. What I wanted to highlight here is people were aware, I think, and that is why a lot of closer to the in the money, not many put writing or call writing is there. So people have taken safety precautions. So people have. So if you see, the put writing is at 22,000 and 22,200 only the maximum, and call writing is at 22,700, 22,800, and 23,000. So people have been careful in writing writing options because of the uncertainty. Now Reliance, it reverted back to, but till the time it is up above this 2850, 2900 levels, it's good. Nothing to worry about. It had corrected last week. Now the sector which was doing well last week was Nifty Metals. It made an all-time high and it was going up. It's trading well above all its moving averages and has gone much above that decline of March also. And the stocks here which were doing well, first is Vedanta. Now it is kind of overbought. The reason why Danta was doing well is because Hindustan Zinc is not traded in FNO. So Hindustan Zinc is a clear play on silver. So to play silver trade and other metals, other base metals, the easiest trade is to play in Vedanta. So it is made a new high around 370 odd. So it's in a big bull trend. Now the other stock like Tata Steel, it went up to 170, but it has corrected to 163. So, but with the interest in all these issues and metals, this should do well. The other outlier was Hind Copper. Now, here the problem is with Hind Copper. Firstly, it is very expensive. Second, it is now in FNO ban. It comes out of FNO ban and it goes quickly in FNO ban in next 2-3 days because a lot of positions are built, and this is the reason. Otherwise, this is a good stock to trade as such because the tide will turn anytime and the prices can correct to a big level. So I would not recommend cash buying, but it is good for trading. Nifty Bank, if you see here, it made a fresh all-time high to around 49,000 and then retraced below that level. This is a weekly chart. So we'll have to see this. So if it makes a higher high here, the trend will change because the trend of Nifty Bank had changed because it had make a lower high. So if it makes a higher high, the trend will change and it will also become bullish from here. This is a daily chart. So it has gone up to 100 EMA, but it has again corrected gone up basically based on the interest in HDFC Bank. So we'll have to see this now. What happens with HDFC Bank from here? HDFC Bank, if you see, this is a daily chart. This was the retracement on the chart. So if you see here, it has retraced and had gone up to the 50% retracement levels and then is correcting from there. So we'll have to see. It made a candle below the 50% retracement. So next support should be around 1500. So if 1500 holds, then you can hope for a bounce back. And otherwise, it will again test that lows it has made earlier. ICICI Bank had a positive week. This is a daily chart. So if you see here, this is a it had a symmetrical triangle breakout. This is a daily chart. So it was heading higher, but then it corrected because of other issues. So, but this is a stock which is bullish. The level to trade this or get into this would be closer to 20 EMA. That should be a decent level. We'll have to see. I think this one should go up to 20 EMA on Monday and then bounce back from there. The stock here, IDFC first, is a weekly chart. This had a clear breakout from the declining trend line, and now it is above that 20 EMA also. So it is headed higher. So it can go up to that earlier highs of around 90, 92 odd levels, and then we can see from there. Uh, PSU Bank Index, it had a negative week because basically because of the results of the PSU banks. There's nothing great about that those results. So it corrected a bit. This is SBI. This is a weekly chart. So SBI over this declining trend, rising trend line has taken support after the fall. It went fall up to that 720 odd levels, and then it is rising up. So we'll have to see here what happens from here. It can go up to 800 odd levels or then retest the rising trend line again. We'll have to see there. Bank of Baroda, another bank which was doing well, but it took support at that 20 EMA. But last week was red basically because of the business updates, which were not very encouraging as compared to other banks. The PSC index is doing well, and it is now gone nearly to its all-time high, and it went above the decline from where it declined in March. So this is one sector which is positive. Among the stocks here, the one which is doing well is BHEL. So it is expected to do well based on the orders inflows and all. But one has to be careful with this stock because results are always underwhelming for this stock now. But right now it is in momentum, so keep trading this. The other stock which is doing well is NTPC. It made an all-time high, again based on thermal power and their IPO, which they are likely to bring for green energy. So again, this is a good stock which is in a good uptrend. IT had this last week was soft. It is below the 20 EMA, and that rising trend line thing has been broken. Now we'll have to see how the Nifty IT reacts after the TCS results, which were slightly okay, but not a howler. And the order book was good, so which was encouraging that it gives a visibility for the next year at least. And TCS above this 20 EMA looks good. It went up to that level and then has bounced back from there, that 3900 levels. So we'll have to see how it reacts on Monday to the results. Uh, it should not really bounce back, but it should not correct also in a big way from here. Infosys has been weak and is now below this rising trend line support it was taking. So it tried to bounce back, but then it has corrected and has now come exactly at that support zone of 100 EMA. So at 1480 odd. So if it falls from here, then it will test that 1400 levels and go to test the 200 EMA. So one has to be careful with this. Auto index made a fresh high, and this is one strong sector, and it has now gone much above its last all-time high. The reason is one of the reasons is Maruti. This is one which is doing well, and it should post good results. So every major dip from here is an buying opportunity in Maruti if it comes closer to this 20 EMA of 11,300 odd. So if you get it on Monday or Tuesday on a dip somewhere closer to these levels, this is a good opportunity to get into this stock. Uh, the one other stock which is doing well is Mahindra and Mahindra. It made a fresh high based on complete because it has got EVs and it has got that UVs, that is utility vehicles and tractors, etc. So it is making fresh highs. Energy index has come back to its nearly come back to its all-time high. So this is another sector which is doing well. This is led by Tata Power. Uh, in anybody who is looking for a renewable energy play, this is one of the safest play because it has it plays both renewable energy and it plays the thermal energy aspect also. So this should be a safer play to take. So every dip should be a buying opportunity uh, in Tata Power. It had consolidated for a long time. Uh, Basically, it was a time-wise consolidation, but now it is broken out and it is above that levels. Infrastructure, Nifty Infra is again doing well. It has made fresh highs. So this is again a positive sector. All the stocks which are there in this are doing well. One of the stocks which is the main stock in this sector is L&T. Now it has dipped in the last week based on a negative brokerage report. So it is very good if it comes back to this 3300, 3400 levels. This is a good opportunity to accumulate this stock. The brokerage report saying is that Middle East or the Saudi Aramco thing will be slower, so the order flow etc. will be slow. So, but this is a good. If it corrects, it will be a good opportunity to accumulate this stock. Now, Midcap index, it made a fresh all-time high, but then corrected now. But it's in momentum, and it is. If you see the RSI is above 70, it is on weekly chart, so it should do well from here. So all the mid-cap stocks, whose results and all will be good, will continue to lead this sector. Small cap index again, if you see here, it is going up, and it is basically because of the interest and the performance of the stocks, interest of the retail interest and the performance of the stocks and money which is flowing from mutual funds. Now, I wanted to discuss this Praj. Now, Praj, because of this regulatory actions against the ethanol play, where the government had stopped the ethanol diversion of sugar to ethanol, it corrected big time. So, in case you want to get it, try somewhere close to this 440 level, where the it made a last low in March. That should be a safe level to get in because regulatory environment has not changed, and I don't think it will change uh, uh, till the elections are over. The other stock which is doing well is Action Construction. This is a direct play on road infrastructure development. It made a fresh high to 1700 and it's on an uptrend. It corrected because it came under that ASM category. So that's why it corrected. So people must have closed their positions. But it's a stock which is in a good uptrend. Uh, Now I'll cover.
We'll discuss three stocks today. First is BEL. It manufactures radars and networking equipment, which is part of Defense Electronic Software Communication products. With zero debt and comfortable working capital position, it is well placed to benefit from defense opportunity. BEL has received rupees 26,000 crore plus orders in 9 months FY24 and already surpassed its 20,000 crore FY24 expected guidance. 193 items of the 1100 on the import embargo list are manufactured by BEL. Exports should rise to 11% of sales by FY30, expected from 3% in FY24. Being a market leader has given it a strong head start, and it has a depreciated asset base compared with private sector peers who began an investment cycle in the last 6 to 7 years, which will help the margins and profits. So BEL is a market leader in domestic defense electronics. MOD is discussing with BEL to find alternatives to Russian vendors and operation and maintenance of Russian equipment. Let's see their profit and loss account. So if you see here, this is the order book. This is in millions. So this is roughly uh, 67,976 crores for FY25. Their net sales are roughly around 23,000 crores. So it is roughly three times the net revenues or sales. That is the order book. Growth is expected to be around 20% over the next 2 years. Uh, EBITDA margins are improving and they are reaching now 24-25%. Profit is improving. So they are expected to do an EPS of around 6.1 this year and 7.4 next year. ROC, ROE, etc. are improving. They're expected to be 30 plus range. PE is declining, so which is good that the stock is now becoming less expensive. This is the this graph shows that how BHEL share has risen as a proportion of India's capital spend driven by indigenization push. So now if you see here from FY12, FY14, when it was around 6%, it has reached around 10% now as the defense expenditure is going up and it is expected to be around 16% by FY30. So that means it is gaining market share. These are their immediate 3-year order flow pipeline. Quick range surface to air missiles, long range surface to air missiles. These are roughly 15,000 odd crore orders. Akash missile, 5,000 crore order. Base defense orders, base non-defense orders, night vision devices, T-90 SM, army tanks, etc. So roughly 56,500 crore orders are there in their order flow. So if you see there here, order book to drive 19% CAGR in revenue growth over next FY24 to FY26. So revenues are going up while order book is also going up. Average execution is improving from roughly 30 to 40% now. It is going to go up to 50 to 60%, which will drive the revenues in a big way because at the end of the day, it is a profit in your P&L which matters. Their ROE, ROC is improving and it's expected to reach around 30 plus category, which will drive the profits. Now, we see the chart here. It has been gradually moving along this 20 EMA and it bounced back from the 20 EMA in March. So that should be a good level to get into this stock. Right now, it is doing well. It is at around 230 plus. Now, we had seen the expected FY26 revenue of around, EPS of around 7.4. So at 30-35 PE, it should trade at 220, 260. So present price is 230. So another, if it performs well, another 10 odd percent upside is possible. And in case the order book is good and the execution is good, it can easily go up to 300 also. Next stock which I wanted to cover is Concor, Container Corporation of India. It's a key beneficiary of the dedicated freight corridor DFC, which is likely to result in volume growth driven by model shift and enhanced operating efficiencies. The DFC connecting Dadri to Mundra became operational in FY23. It has been continuously increasing the number of double stack trains to 1376 in December 23 from 777 in December 21, which could lead to lower transportation cost per container, improving the company's cost efficiency level. Expect domestic operations to scale up 35% contribution in 9 months FY24 due to the addition of new services, commodities for multiple sectors, and a strong network of terminals. It has deployed 75 LNG trucks at Chennai, Nagpur, Baroda, and Ankleshwar terminals and is witnessing healthy returns. Management has guided LLF expenses at rupees 450 crore in FY25, assuming a 7% escalation over FY24. LLF is land licensing fees, which they pay to Indian Railways mostly from whom they take land for keeping their stores. So it is aiming to reduce the land licensing fees expenses by shifting volumes to its own terminals. This land licensing fees was roughly around 500 crore earlier. It has come down a bit. Now let's see their P&L. Uh, they are their revenues are growing up around 15 to 17% over the next 2 years. It's expected to reach uh, around 9,890 crore in FY25 and 11,585 crore in FY26. So EBITDA margins are improving. It is expected to reach around 24% now in FY26, which is good, a big improvement. Uh, its EBIT and profit before tax are expected to improve, and it is going to report decent profits. The profit are improving at around 20% growth, uh, and margins are also expected to be better. So EPS is expected to be around 31 odd rupees in FY26, uh, with a PE of around 29 to 30 right now. Return ratios are improving. They are in low double digits. ROIC is 28%, asset turnover 0.8, and debtor days, etc., are under control. So the basic ratios are under control. This is the routes and station of Western Corridor for the DFCC. It starts from Dadri and it goes right up to JNPT in Maharashtra near Mumbai. It has offshoots going up to the ports in Gujarat, Mundra, Hazira, etc. And so it is partially constructed, and it will be completed in shortly. Now this is the picture of those double containers which it is running. So which is decreasing its cost and increasing its volumes. The point with the container corporation is that two-thirds of the uh, revenues or the volumes are from Exim, and one-third is domestic. Now the domestic volume is improving, but the Exim volume, that is the export-import volume, is stagnant. And this is the reason why the total TEUs, that is 20-foot equivalent units, by which these volumes are measured, is not really going up substantially. Now, if you see segmental revenue and profitability, uh, the Exim volumes year on year have grown around 13%, while domestic have gone up 7%. But Q on Q, they have been falling, Exim volumes. And this is because of weak trade volume due to geopolitical headwinds, which had hit the export and imports volumes. Domestic operations will scale up and should provide more than 35% now after 25 FY25 and FY26 due to addition of new services and commodities into the transportation part. So ramp up on domestic volume should be at a CAGR of 10%. And LLF provisioning, that is land licensing fees provisioning, should help them. And lower LLF costs will also help their margins. So EBITDA margins are expected to be around 23 to 25% over FY24, FY26. Now we'll see the handling volumes also. If you see here, in TUs are not growing up substantially Q and Q or year on year. EBIT has improved for domestic, but rest is at the similar levels. Now, Exim handling volumes and realization, if you see, it is generally at the similar level. The growth in terms of Exim TU is there, but the realization, that is INR per TU, is not there. Domestic handling volumes and realization are improving, both in terms of volumes and realization. Revenue growth to be driven by domestic volumes, so they are expected to improve. EBITDA and margins to improve with lower LLF provisions and provisioning of DFC. This is their chart. So if you see here, it was at around 500 odd in March 23, and it has risen above that. It made an all-time high of around 1100. But it has corrected from there, sorry, 1025, and it has corrected from there, came to its 20 EMA, which should be a decent level to get it at around 800, 825. Because of number of concerns regarding volumes and private players also coming into this sector from the ports. The last stock I'll cover today is Shriram Pistons. The company is the largest manufacturer of pistons, pins, rings, and engine valves in India, with two manufacturing units in Ghaziabad, Uttar Pradesh, and one in Pathredi, Rajasthan. Its products are marketed to almost all OEMs and aftermarkets under the brand SPR and Usha. It is accelerating diversification efforts in EV specific and engine agnostic parts. Multiple new powertrains are emerging in internal consumption engine. It has invested in related product development via both technological partnership and in-house R&D. In EVs, Shriram Piston has come up with grounds up India-specific products on the motor controller front after extensive testing and validation. Company has recently made an investment of rupees 70 crore for new land in Coimbatore for expansion in EVs, motor controllers, combination assemblies, and others. Current capacity utilization is 75% on an average, hence enough headroom to support growth. Extensive footprint in the aftermarket, over 1,200 touchpoints in India, presence across 45 countries, including servicing network, would be utilized for growth in EVs as well. Now, the point here is, along with internal consumption engine and electric vehicles, CNG, LNG, hydrogen, hybrid, flexi fuels, ethanol, will also coexist with both of them. Hence, there is a possibility to make good value from alternative powertrain solutions, which is higher than presently, which is there for internal consumption engines. Now, if you see here, the revenues have been growing at around 10 to 12% over years, over every year. EBITDA margins have been improving. Now it have reached 20% now. EBITDA margins growth is also good. PAT margins are also improving. Now they are reaching around 15%. EPS is expected to be around 134 in FY26. Debt is declining. It's a zero debt company. And post-tax ROC is now reaching 20% mark, which is good. So the broker who has analyzed this, they are factoring in 13% CAGR growth over FY24, FY26, EBITDA to compound at 15% with sustained margins at around 21.6%, profit CAGR of 17% over FY24, FY26, and they have net cash balance sheet. So the net debt to equity and net debt to EBITDA is positive. They will do they will be doing continuous healthy cash generation. So they are able to do with that around 200 crore of capex every year over the next 2 to 3 years. So the cash flows, capex, and free cash flows are all positive, which is helping the capex and acquisitions. ROE to sustain at above 20% level. ROE is also healthy in double digits, so it should help. The good part about Shriram Piston is it dominates the playing field with 45% revenue share. So if you see here, it is grabbing the market share. So the revenue market share has been improving now year on year. So it has reached around 47%, and it has taken this market share from its competitors. And that is why this stock is preferred. As the total market size is, this is in millions, so it's around 5,500 odd crores. So they make around 2,600 crores out of this. Hence, it's a stock to be kept in mind. They are doing long-standing tie-ups with players from Germany and Japan. So they have for various products, pistons, rings, pistons, and engine valves with various companies in Japan and Germany. They have done two acquisitions, EV specific and engine agnostic parts via recent acquisition. So they are diversifying into other fields. So for electric vehicles, They did this acquisition of EMF Innovation Private Limited. This is in Coimbatore, so which will help drive their electric vehicle portfolio. And Takata India Precision India Limited. So this they did in Nimrana, Rajasthan. Now this will drive their growth in automotive parts, office automation equipment parts, optical equipment parts, essential facilities parts, and medical equipment parts. And they have good customers, OEMs and others related to this. Now let's see the charts. They did a bonus issue here. The stock was consolidated around 20 EMA and then has gone up in January onwards. So it had made a fresh high. This is a good stock to hold. After the result, somewhere closer to 20 EMA should be a decent level to get this stock. I have finished. We will take questions from him.